All right, so what does the VA IRRRL stand for, right? It's the Veterans Administration Interest Rate Reduction Refinance Loan. Yes. And if you could imagine how many times I have that conversation with folks a day, we just call it the Earl, right? But yes, that is exactly what it is. And it is a streamlined, no documentation, technically no FICO requirement loan for those that already own a home using their VA home loan benefit to rapidly reduce or refinance your monthly payments or your rates. So what exactly is the VA Earl? Well, it's a tool that sounds exactly what it is. It's a way for you to refinance or reduce your monthly payments or your interest rate to save money long term. Think of it as an upgrade to your existing VA loan by reducing your interest rate. All right, now let's talk about eligibility, right? And there's just a few requirements. One, you must have an existing VA loan. Remember, this is a refinance, not for a purchase, right? Two, you must be current on your mortgage payments. And number three, you can't have more than one mortgage late in the past year. And it's important to know that, as I previously stated earlier, that there is no income requirements, there's no technically FICO requirements, and there's no appraisal, which makes this process very, very quick. Typically, these refinances can be closed in anywhere from 2 to 3 weeks max. Why is the VA Earl such a powerful tool? Well, number one, obviously being able to lock in a much lower rate, at least by half a point better than what you currently have. Two, as previously stated, there is no appraisal or income verification. In other words, as long as you're still currently working, there's no reason to verify how much you're making. As long as you're making your payments on time, you're currently employed, you're good to go. And three, this is probably one of the biggest benefits to folks, is if you remember when you purchased your home, your closing costs, pretty expensive, right? And everybody would say, can I roll these closing costs into the loan? And the answer is no, you cannot. However, with the VA Earl, you can technically roll the closing costs into your loan as long as it meets that recoup that we were talking about earlier. So very little out-of-pocket expenses, if any at all. In fact, most VA Earls have a maximum cash back amount of $500. All right, so we just talked about benefits that I can legally say. Let's talk about some indirect benefits, properly structured, or if your loan officer will properly structure the deal and you take action, right? The first one is what I call reinvesting. What do I mean by that? Well, when you close on the new loan, typically you have 45 days until you make a new payment. So a lot of times when we close these loans, you want to close them at the beginning of the month. So therefore you do not have to make the payment on your current loan as it stands with your current rate. So that means if you don't make that payment, you're skipping 1 month. And then because you closed in that month, you skip another month and you actually make a payment in the third month or 2 months down the road, right? So in essence, you have 2 months worth of mortgage payments that you don't have to make until you make the first payment on your new loan. So those 2 payments, keep them in the bank. Now, granted, it's your money. You can do whatever you want with it, but I always recommend you keep it in the bank, right? So that way, when you get ready to make the first payment on your new loan, you make it, and then those 2 months worth of payments that you held on to, you apply it directly towards the principal. Now, everybody's like, Jay, why would I do that? Well, if you remember compound interest, Albert Einstein once said, compound interest is the 8th wonder of the world. Those who understand it make money. Those who don't pay it, right? By taking those 2 months of principal or those 2 mortgage payments and apply towards the principal, you've in effect reduced how much interest you're going to pay over it long term and basically have reduced how long it would take you to pay off your home loan. All right, indirect benefit number 2. Just like with the fact that you were able to save a couple months of payments and reapply it back to the principal, when you close on your new loan, your loan officer with your company is going to have to rebuild your escrows, meaning the money that is put in there for your property taxes and your homeowner's insurance. Well, with your current loan, it has an escrow account that will typically have money in there. So when that is closed, those monies come back to you in the form of a refund check. Sometimes it takes anywhere from 3 to 6 weeks, depending on how long the previous servicer takes to cut the check and send it to you. But again, same principle applies. Just like what you did with the 2 mortgage payments that you saved, those escrows that came back, apply that towards the principal. The more that you can throw towards the principal, the quicker you're going to pay your loan off. And again, like I said, got another video that talks all about that, how just by applying that simple philosophy, you can take 4.5 years off your home loan. Okay, now that we've talked about benefits, I'm going to have to talk to you about red flags, right? One of the biggest red flags, it's not the most important, but it's pretty high up there, is when somebody says, you get a no-cost loan to do this. That is bullshit, right? Yep, I swore on YouTube. Good thing I say this isn't kid-friendly. There's no such thing as a no-cost loan. Everything from the funding fee to third-party fees, meaning your title and escrow, and to prepaids and lender fees, right? So you really need to look at the line items on that loan estimate that they provide you and the closing disclosure to make sure that you're not getting socked with a ton of fees. So watch out for the no-cost loan, because every loan, purchase, refi, you name it, has costs associated with it. You just got to mitigate the costs. Number two, too good to be true offers. Here's where you got to do a little homework. Search around, see what competitors are offering, right? What rates they're offering, but then make sure you understand whether those rates come at a cost or not. If someone says, I'm offering you a 4-point low crazy rate, and they just leave it like that, that may be true, but there may be a huge cost that comes with it. I'm going to show you a slide here in a minute where I talk about this, where if the current market is showing rates at like 6%, but then you see an ad for 5.1 and it has an asterisk on it, well, that asterisk has a reason. It'll tell you there's fees, loan costs, points, etc. Right? So watch out for the too good to be true offers. We're here to help you improve your foxhole, not make it worse. So to wrap it up, the VA Earl can be a fantastic benefit for those that need it. And again, you got to remember, you got to weigh the pros and cons, right? It's a great tool. In fact, anytime that you can do it, I highly recommend it. I've done it multiple times on the multiple VA home loans that I've had, on the multiple properties I've had throughout my career and through my life. Remember, if you ever have questions about the VA Earl, drop a comment down below. Let's connect. Let's talk about your options. Let me and my team help you improve your foxhole, not make it worse.